Hello everyone, and welcome to Baker Boyer's semi-annual business panel. I'm Mario Delgadillo, Regional Business Banking Manager. This is our first panel of 2022, and today we have an excellent group of speakers for you. We're thankful to be joined by Gail Stack, owner of Everstar Realty, located in the Tri-Cities area. We also have the pleasure of being joined today by Dr. Patrick Jones, PhD, Executive Director of the Institute of Public Policy and Economic Analysis. But before we begin our panel, our very own business advisor, Ashley Mahan, will share the results from our latest business climate survey. Thank you to everyone who had the opportunity to participate in the survey. And for those that didn't have a chance this time around, we'd love to hear from you. We believe you'll find the results insightful and helpful with your future business planning efforts. Once again, thank you so much, and I'll turn it over to Ashley Mahan to begin.
Hello, and welcome to the second annual Business Climate Survey presentation. My name is Ashley Mahan, and I'm a business advisor here on our commercial lending team in Walla Walla. Today, I'm going to share the results of our 2022 Business Climate Survey. The intention of this video is to provide you with a brief presentation of the survey results, including commentary provided by survey respondents. Our goal is to conduct these surveys annually to get a sense for how our business communities are navigating the current business climate and how they are positioning themselves for the future. As we go through the slides today, please keep in mind that this is our second survey, and we've made some tweaks to the survey from last year, so we're not quite ready to provide comparative data or trend analysis, but we had a decent participation rate, and I'm excited to share some high-level results. With that said, let's dive in. First, let's get an understanding of the makeup of survey responders. Then we'll review each survey question along with the responses, and we'll conclude with high-level results. I have 3 slides for you to get an understanding of who took the survey, so please keep this information in the back of your mind as you think about the survey results. Here we can see that we had good representation of participants through all 4 of Baker Boyer's markets, with Walla Walla and Yakima making up the most of the audience. Yes, these percentages add up to more than 100 because some of the businesses check that they operate in more than one location. FTE counts within these businesses show that 65% of respondents have 20 or fewer full-time equivalent employees. As with last year's survey participants, the majority of the businesses responding are mature in age. I was happy to see that we've had a broad range of gross annual revenue figures represented as well. Lastly, here we can see that there is good diversity across industries. Within the other category, there were a couple of wineries, a brewery, a government entity, and a real estate servicing business. So to recap, as a whole, survey participants are mostly from Walla Walla and Yakima. They're small, with 20 or fewer full-time equivalent employees, but established, having been in business for over 10 years, and they're diverse in terms of average annual gross revenue and industries. So now that we have an idea for who answered the survey, let's go through each of the 12 questions. First question is asking about expectations in 2022. As we can see here, this year's expectations are that gross revenues will increase, profit margins will remain the same or decline, and we can expect to see some businesses invest in capital projects, while employee turnover is expected to maintain the course. Employee turnover is expected to be consistent with last year. There were a couple comments surrounding the use of technology to solve some employment needs, such as hiring contractors and virtual assistants, and also turning to robotics to reduce reliance on the workforce. For those expecting a rise in gross revenues, we collected comments about businesses forecasting increased sales volume and businesses in industries who have benefited from increased demand during the pandemic and expected it to continue into 2022. Many of those who are expecting a decline in profit margins cited increasing cost of payroll. The trend from all the comments showed that higher costs of goods sold and wages are creating a need to increase prices, which is in turn expected to help increase gross revenue, which is resulting in the consistent profit margins expectation. Question 2 attempts to further understand those capital spending projects anticipated this year. 23% of respondents are not planning on increasing capital spending, But from those who are, the majority of them will be purchasing equipment. Companies within the restaurants, bars, or alcohol production industries commonly reported multiple areas for capital investments within equipment, facility improvement or expansion, and furnitures and fixtures. Over half of the survey respondents agree that the most important factors to their profit outlook in the next year are cost of goods, sales, the economy, and employee pay and benefits. Next, question 4 looks at the drivers of revenue during 2021. 76% of companies reported that the pandemic affected their revenue last year. 44% of those said COVID has been the cause for lack of revenue growth, while 32% said that COVID has contributed to revenue growth. Those citing COVID as a contributor to revenue growth were primarily within the construction, finance, or insurance industries, and then also within retail and restaurant or alcohol industries cited COVID as a driver of revenue growth, which I'm guessing could be correlated with a strong tourism last year. For question 5, when asked to rank these items in order of greatest impact on improving productivity and efficiency going forward, 26% of these participants agreed that the supply chain is the number one most important. But as you can see here, that there wasn't a significant consensus among the survey respondents. So I looked to see if there's alignment within industries, but the rankings were quite varied. So I think a good takeaway here is to remember that your business is unique. Maybe your competitor is focused on innovating, while your biggest priority is reorganizing management to ensure the company is set up for the future. Question 6, when asked about profitability in 2021, we see that most said it grew. Of the 66% of survey respondents reporting profitability growth last year, keep in mind that 91% of them have also been in business for over 10 years. And from question 4 earlier, we know that the reasons were mostly attributed to increased demand. Within these responses, delays in the supply chain and cost of goods were cited among the most common reasons for a flat or declining profit margin last year. When comparing 2021 results with 2021 expectations, 23% of the participants in last year's business climate said that they expected profit margins to increase. Bearing in mind that the survey participants are not the exact same people year over year, generally speaking, expectations did not match reality. Profitability grew last year when most thought otherwise. Question 7 intended to dig deeper into business plans for 2022. Clearly, businesses are expected to make changes to their prices. Comments from participants overwhelmingly noted their price increases will mirror the increases in their raw materials and employee compensation, which matches national trends. Comments about changes in business strategies and business investments noted expansion of facilities or services or changing product offerings. Some people mentioned investing and implementing technologies to increase sales or improve efficiency. And as noted within the commentary mentioned on the last slide, here on question 8, we can see which boxes were checked for the most common drivers of price changes, which you're probably not too surprised by. So next, coming off of a few slides about increased expenses and expectations of price increases, it's great to see here that businesses are feeling pretty optimistic about 2022, with 5 being highly optimistic here. And with the next slide, we'll see they expect revenues to maintain the course or grow. So here, look, optimism is alive and well. Capacity and momentum were some of the main commentary themes here. Some quotes included phrases such as, our capacity will be much greater, more inventory for more sales, we're securing additional volume, and this is my 3rd year in business and we're gaining momentum. And also, we have plenty of work lined up, but I'm worried that we could have some kind of slowdown. So a little caution there with the optimism. All right, second to last question. Question 11 asks about pressures businesses are facing within non-wage compensation, economic policies impacting their decisions, compensation pressure for new hires, for skilled workers, and lastly, wage compensation pressure overall. Dark blue represents yes to the pressure, showing pressure in most of these categories, with the largest agreement being compensation pressure for skilled workers. To give some examples from the survey comments, one participant said, "Keeping our skilled workers paid relative to new hires has been a struggle." Another pointed out that a shrinking labor pool and inflation are forcing higher pay. And now we're at the last question from the survey. The second and last bars on this slide relate to price trends and hiring activity, which we've covered in pretty good detail already. Comments associated with these questions are consistent with earlier remarks. Yes, price increases are planned to match the increased cost of materials, payroll, etc. Now, the first bar on here says, "Are terms and availability of credit influencing capital spending plans for your business or the businesses you are familiar with?" Overwhelming response is no, meaning that business financing is not causing issues for capital spending plans. Some say financing has been reasonable to obtain. Others say that their cash flow from their operations has been sufficient to cover capital spending projects. On the other hand, shown in the third bar, when asked if there are any recent changes that might affect capital spending activity, many participants noted issues within the supply chain and inability to find equipment. So while survey respondents noted earlier that they plan for equipment purchases in 2022, many of which are also reporting that they're having a hard time accessing these desired purchases. So if that sounds like you, know that you're not alone. And to wrap this up, here are some quick key observations. So employees. Many are having difficulty finding skilled workers, and those workers are demanding higher pay. Overall compensation increases are taking place this year if they haven't already. And I think it's interesting to note that a few of the survey participants shared that they will be looking to technology to reduce the reliance on the shrinking and more expensive labor pool. Next, inflationary pressures. Demand, rising costs of goods sold, and increased compensation are putting upward pressure on businesses to increase prices in order to maintain profit margins. And lastly, optimism and growth are very much expected in 2022. 89% of survey participants expect sales or revenues to remain stable or accelerate compared to 2021. And 83% are planning for capital investments to continue at their current pace or to increase them. Equipment will be the primary category of asset investment if the supply chain can support the demand. This concludes our business climate survey presentation. We will distribute these slides to everyone who provided their information when completing the survey, and we'll have it available on our website soon. I want to extend a big thank you for those of you who participated in the survey. Please look for this survey in the future and we can continue to learn from each other. Thank you.
Hi, my name is Gail Stack, and I am owner and commercial realtor at Everstar Realty in Kennewick. And I've been asked today to provide you with an update of our Tri-Cities real estate market. And first, I would like to go over, residential sales. We've all known that things are hot out here, but how hot are they? During last year, or actually 5 years, I think our average home sale price has increased 53%. Our current average sale price is about $406,000. That is dramatic in our market. We have not ever seen those types of value increases. And our current number of sales is about 15% higher than last year. We sold nearly 5,000 homes last year, which is very good volume. And there has been absolutely no drop off in the past 5 years. The inventory that is available is has been hovering around the mid 300s to low 400s for about the past 2 years, which is very low inventory, which still tells us there's a seller's market out there. Most homes are getting, if they're priced appropriately, let's put it that way, will be getting multiple offers, and many times they get offers that exceed the asking price. So it's a bit of a bidding war out there still. Those that go on the market and don't get offers right away are generally a little bit overpriced, and that price should be evaluated a little bit. Our number of actual closings, once again, has been very consistent with regards to our numbers over the past 5 years. So our residential market is hot. We have a lot of new construction happening. We have a pent-up demand. And as long as the interest rates stay favorable, I foresee this to continue. But we've all heard the rumors about interest rates, so we'll see how that comes to play during this next year. So moving through our market and talking a little bit about rentals, our occupancy in rentals, and this is across the market, high-end, low-end, mid rentals, is 100%, for sure, 100%. There is turnover. People move from one spot to the next. People move out. People move into the market. But that has not really changed our occupancy rates whatsoever. So that has put pressure on our rents. So our rents, since the coronavirus moratorium has been lifted, has been increased by anywhere from 25 to, in some cases, 40%, and continuing to go up. And that is also a pent-up issue because we were unable to increase rents during the coronavirus moratoriums. And that was about an 18-month period. So we're in catch-up at this point in time, I guess you might say. Although the rents that we're seeing are higher than I've ever seen, much like the sale price. So it's continuing on throughout the market. Our rental turnover rate is down because of our tight residential sales market. There's fewer tenants that we're seeing able to purchase homes, fewer homes available, and so they're not moving quite as much as they used to. So that turnover rate has dropped a bit. This year, it could be even less, as once again the predicted interest rate increase will affect the affordability of housing as it relates to tenants being able to purchase their first home or something of that nature. So we're still feeling the effects of the eviction moratorium, although most of the units that we have managed, we've been super fortunate that we have only had about a 1% eviction rate after all is said and done. They've managed to get the county, state, federal assistance, catch up on their rents. We've worked with tenants, but there has been some eviction that we have had to do. So along with that, I think what has affected the rental market the most and is affecting it, and it still remains to see how much it's going to affect it, is the significant change for rental property owners was the passing of the House Bill 1236 and the Senate Bill 5160 that happened during coronavirus. So these bills caused sweeping changes to the landlord-tenant relationship, squarely putting the tenant in an advantage over the landlord. There's now a 60-day notice to increase rents, whereas there was a 30-day, and now they've also eliminated the 20-day notice, no cause termination for the landlord. So the landlord now carries the burden of proof to terminate a tenant. Many times these will go into actual evictions. If they do go to evictions, most evictions are being litigated now, almost all of them, because the tenants now have free legal representation to do that. So along with the complexities of the landlord-tenant law, I would recommend consulting an attorney if you're faced with an eviction, and for further education and clarification on those changes to the landlord-tenant law. So despite the challenges in multifamily and rental housing, the sale market continues to see record-breaking high prices. It's commonplace for duplexes and fourplexes to sell over asking with multiple offers. About half of all these sales are cash, and if financed, many times these sales we're not seeing appraisals come in at value, they're under value, because it seems like each sale is pushing the market a little bit higher. So therefore, buyers are needing to put in additional cash to the deal to make it happen. And it's an extremely competitive segment of the market. There's very few multifamily duplexes, fourplexes on the market. And when they do come on the market, if priced appropriately, they are going very quickly, multiple offers over asking. It's what we're faced with on that segment. So the next thing I want to talk about a little bit is capitalization rates, or as we call them, cap rates. So this is a method of value of putting a value on a property based on its cash flow. So basically, it's net operating income divided by the sale price, which equals your cap rate. Or you reverse those equations and you come up with your sale price, one or the other. And keep in mind, this is a quick snapshot of the potential return on the investment without factoring in a loan or escalations in rents or expenses, future changes or values. So it's a quick method for commonly analyzing an investment by a buyer and for valuing an asset for a seller. It's used many times in the market to just stack up investments next to each other and see where they land on a snapshot at that given moment. So cap rates are a funny thing. The lower the cap rate, the higher the sale price, which favors the buyer. And the higher the cap rate, the lower the sale price favors the seller. So once again, it factors in your net operating income or your cash flow into your sale price to come up with a rate of return. So I talk about that because the next section we're going to talk about is large multifamily apartments. So this is another really competitive part of the market. So we're talking apartments, and they can be anywhere from 10 unit, 20, 30 units up to hundreds of units. Rarely are we seeing apartment complexes actually come onto the market. They are most of the sales right now are unsolicited offers, and they're very generous offers. I've recently seen a few come across that were astounding. The multifamily market is seeing the lowest cap rates in history. Some metro markets have seen high quality, newer constructed apartment buildings at a very low cap rate in the 3 to 4%. And these are generally cash deals because when you factor in financing, it doesn't leave a lot for any return whatsoever. So the Tri-Cities is seeing cap rates on multifamily in the 5% range. So we're pushing down just like all the other markets. And once again, many of these complexes that I've seen sold are not even going onto the open market. There's unsolicited offers. The other thing that's factoring into this increase, lower cap rate, higher sale prices on a multifamily is the cost of building materials and the challenges with the supply chains. It's had a big effect on pricing overall. So there is currently a pent-up demand for multifamily complex sales. There are a lot of buyers out there in the market that have substantial amounts of money and a lot of cash to invest. So that is a pent-up part of the market. So the next category will be commercial. And commercial have a pretty broad umbrella, whether it's retail, office space, industrial, medical, mini storage, could be any of those, really. Commercial property ownership was affected by COVID, but in a very different way. Fortunately, many of the complexes that we manage were able to get the PPP assistance through the government to pay their rent and pay their expenses. So they were able to stay in their office spaces, and so we haven't seen large portions of vacancy as a result of that. We may see, and what I'm hearing in the metro markets is that there is some fear that because of a high portion of the workforce is working remotely, that we will see a marked increase in office vacancies. And that's, I believe, mostly metro markets. We may have some trickle down here as it relates to the Hanford area, and some of those larger contractors who occupy those larger spaces may have more people that are actually working from home. We may see a little bit of excess office space hit the market, but for the most part, it has not really hit us in a very negative manner yet. We may see this over the next few years as leases expire and companies do take a second look at their space needs. Landlord-tenant laws are apply to commercial like they apply to residential. So we have seen challenges navigating the tenant relationships, but we have not seen a very high rate of eviction, I guess you might say. Most everybody has managed to keep their space or allow their lease to terminate, and then will release it. So the rents on commercial have not really been increasing much. Where we have seen the higher rents is on new construction office space, and that is a result of the cost of construction and not necessarily the market. The market rates have still been pretty flat. In some cases, we went backwards during COVID, and now we're coming back up to where pre-COVID, I think, on a few buildings that we're working on. The commercial lease rates are driven by the location, the use, whether it's office, retail, medical, the age of the building. So we see a really wide variety of lease rates throughout the Tri-Cities. So it's very much dependent upon the location and what the type of the property is. And the last segment, that I'll just close with is when you're analyzing an investment property, it's an individual choice. Why are you buying the property? Are you buying it for cash flow, equity appreciation, long-term hold, short-term hold? Is it a 1031 exchange? There's so many reasons. So I think it's really important that if you're buying or selling, that you have a real clear goal in mind on how you want to purchase an investment property and the reasons why you want to purchase an investment property. So there you have it in a snapshot. I hope it helps with your investment property goals.
Hello, everyone. This is Patrick Jones from Eastern Washington University's Public Policy and Economic Institute, and I'm here today to share with you some insights from the latest data we posted to Benton Franklin Trends, a website that's been there for informing the public in the greater Tri-Cities area for about 5 years. So we will consider those key economic forces behind the local economy. So we'd like to start our brief look at the Tri-Cities economy with a fundamental driver of activity, and that is just the number of people in the two counties. So we're going to look at population and the annual growth rate. If you're familiar with Benton Franklin Trends, This is the very first indicator that we show. And it's clear from the graph that in 2021, the estimate was for 308,000. For a couple of years now, the combined county population has exceeded 300,000. The overall growth over the past decade, that is from 2012 through 2021, was 42,000 plus. So a very strong growth. That growth rate, which is given by the blue line here, was 1.8% per year. To give you some context of that, that is 3 times the size of the growth rate of the U.S., or nearly 3 times, which was 0.7%, and a little bit higher than the state's growth rate of 1.5% per year. So the Tri-Cities has been enjoying one of the fastest, well, probably the fastest growth rate, population growth rate among any of the metro areas in the state of Washington. And the forecast that we have, the one forecast we have from the state's demographers from 2017 show that the demographers expect the Tri-Cities to grow by close to 50,000 people between 2021 and 2030. So there will be a new forecast coming out here within a few months that will revise that. But my sense is it's not going to change too much. It might shade a little bit on the high side, but just imagine that you will have a city of 50,000 new residents within your 2 county boundaries by the end of the decade, according to that particular outlook. Now, what really drives a lot of the economic activity we like to see is wages. So we're going to dive into the category economic vitality, click under income, and then look at the average wage. And this is characterized by a look at the state of Washington as well as a look at the 2 counties combined. For those of you who are interested, you can drill down and look at the separate counties, but we won't do that today because of time. 2020 registered a very strong year in terms of the wage growth. It went up from, you can see here, 55,500 to 57,400. That translates into over 7%. For the first 2 quarters of 2021, which is all we have data for this recently past year, we have a much slower growth rate of 2 to 3%. My sense is that when the year's data finally come in, we'll be looking at about a 4%, perhaps a 4.5% year-over-year growth rate. And then I think it's likely that we will return closer to trend in 2022. Trend over this last few years has been a little shy of 2.5%. And my guess is that we will see 2022's wages go up between 2.5 and 3% in the 2 counties. So wages are important for determining what we take home, what we call income or personal income. So I'm going to take a look at personal income, and this is on a per capita basis. This is a long trend. You can find it goes back to the 70s. And again, the blue line gives how the 2 counties are doing. You can see there's quite a gap between the greater Tri-Cities area, United States, and then the state of Washington. In part, this is due to a very young and a very fast-growing population. When you have a young population that where there's a significant chunk that isn't working, you're just going to have lower per capita rates than you would if you compare that to a community where they have an older or slightly older population. So just like wages, income rose also between 2020 and 2019, over 7%. The driver here was not just wages, however. Like every place in the country, the local economy benefited from a very large flow of dollars from Washington, D.C. We call those transfer payments. That includes Social Security, Medicaid, Medicare, veterans payments. And in this case, in particular, it included the extended unemployment benefits that actually continued on through 2021, but were certainly in place for a good part of 2020. So just to put this 7.2% increase into some perspective, the overall growth rate since 2011 has been 3.1%, so that's more than double. My thought for 2021 is we're going to have personal income come in with a growth rate of 4 to 4.5%. In part, this is because we still saw extended unemployment rates carry through a good part of the last year. For 2022, I think we're looking at a different situation. The forecast from the Economic Research and Forecast Council in Olympia for the state is that the state will only experience a 1.9% year-over-year increase in per capita income. And I'm going to say that the Tri-Cities will do, in general, a little bit better, but certainly not like you've seen here recently. And so I'm going to forecast a year-over-year growth rate of about 3% in per capita income. Now, if we look at per capita income and then we consider employment, then we know not exactly, we get a good sense of what it is going to be in people's pocketbooks and purses. And so we're going to take a look at the employment levels that we've recently experienced in the greater Tri-Cities. And you can see in 2020, no surprise, there was a considerable drop from what we saw in 2019. That drop was about 8,000 workers. But guess what? In 2021, which we can't show yet because the data haven't been compiled, but we have a preliminary estimate on a monthly basis that hasn't been verified. We see in the Tri-Cities that from January through November, which is the last month we have data for, every month in 2021 was above 2019. So if we regard 2019 as the pre-pandemic baseline, it's pretty clear that 2021 saw a return to the growth path that we've seen here for several years. What about 2022? Well, I certainly don't see 2022's growth rate being as big as 2021's has been. First of all, we've got Omicron to deal with in the first quarter of this year, and I don't think that's going to be out of the way in Eastern Washington until then. And then we simply have a situation where, for a variety of reasons, the labor supply is not as strong and robust as it has been. So I don't see employment increasing to be too much above 2021's levels in 2022. So the bottom line for a lot of us in looking at the local economy is then retail sales. So we'll take a look at retail sales. And of course, income and population and employment all contribute to retail sales. The 2020 results have been in now for 2 or 3 months, and you can see that they were considerably above what we saw in 2019. So the pandemic year of 2020 still saw an increase of at least 200 million in the greater Tri-Cities, which is if you check on the chart here, a 3.7% increase, whereas the state of Washington actually declined. That's pretty impressive, I think, that given the strong economy we've typically seen west of the mountains, that here in Eastern Washington we've had your county and actually Walla Walla show a much stronger growth rate in 2020 than than the rest of the state. Now, where have we been in 2021? Well, we don't have all the data in. We've got 2 quarters worth of data in. And of course, they've been remarkably strong. No surprise. Well, first of all, the first quarter was 16% over the first quarter of 2020. So there was a little bit of a pandemic effect in the first quarter of 2020, but not that much. So that's a very strong result. And then we saw almost more than a third in the Tri-Cities in terms of a growth rate in the second quarter, which was really the trough or the worst part of the pandemic-induced shutdown of the economy. So quite a strong result. It matches essentially the state's result of about a third as well. We'll get the third quarter results out for 2021 very soon. I want to say by mid-February. And it's likely they will be double digits. I want to say mid-teens if the monthly data we see at the state level is a guide, and I think it is. And then we won't get the fourth quarter data out till till summer. But it's my thought that they are going to be also year over year double digits from the quarter October through December, not quite as high as we saw in the prior quarters for a variety of reasons. And my sense for 2022 is definitely not as positive as 2021 will have been. We see a forecast from the Forecast Council in Olympia that's very subdued, looking at a growth in the state tax revenue of really around 2%. So those of you who are in retail or depend on retail sales as some of your clients, retailers for some of your clients, I'd be just a bit cautious in 2022. So that concludes this very brief overview of the current state of affairs in the Tri-Cities economy with a look at what the near future might bring.